So what I want to do today is I want to talk about a lot of the questions that our clients give us, talk about the market, talk about the economy, and go through some of our forward-looking statements. So for year to date, I just want to give you an update about how each asset class has been performing. This isn't something that we try and trade on, but I just want to give you an idea. To start the year, I wouldn't have expected that real estate stocks were going to be the best performing sector of the market. They're up 19.1% for the year, followed by high yield bonds, emerging markets, and investment grade bonds at 10.5%. Again, to start the year, if investment grade bonds were yielding only 3.5%, who would expect that rates would fall another 1%? And that's exactly what they did. So investment grade bonds have had a headwind for the last 28 years, and I'm going to touch on that a little bit later. What's been helping the markets currently? There's been positive credit conditions, very strong corporate earnings. In fact, about 75% of companies are currently beating their expectations or meeting. So only 25% have fallen below expectations. If things continue like that, I would expect that S&P 500 earnings per share will probably come in about $21 to $22 a share. So next year, we're actually approaching where we could again hit historical highs for corporate earnings. Monetary policy has been very beneficial to the stock market. The Fed has talked about this QE2, more quantitative easing, which the market seems to like, which to me, there's already a lot of money out there that's not being used, and I don't think more money out there is actually going to solve the problem. It's more of a problem of confidence. One of the problems out there right now that's been holding back the market has been fiscal policy. John Herbers is going to discuss that a little bit later, but we have the Bush-era tax cuts that are going to expire in 2011 unless something's done, and the market does not like question marks out there. So the more question marks out there, the less people are willing to invest. So unfortunately, that's been hanging over the market recently. One of the questions we get most often is, are we going to have a double-dip recession? When we take a look at the leading economic indicators, what they're pointing to right now is that we're actually not going to have another double-dip recession. We're going to have a slower recovery. Whenever leading economic indicators drop below zero, that's when it's pointing towards a recession. And the green lines here are indicating recessions. So recently, this has been an improving number. The leading indicators that have been improving are the stock market. The average work week has actually been very strong, which is usually a precursor to people hiring. Unfortunately, one of the big things that's been holding back the market is unemployment. So right now with GDP growth, people think that, well, they heard that the markets or the recession ended back in June of 2009, but it doesn't feel like it. Most people are saying, is this real? Did the recession really end? Well, if we go from the worst GDP that we've had in 60 years, all we have to do is go from the second worst, and we're actually getting better. So we don't have to get good. We just have to get less bad. So with unemployment, that tends to be one of the last things that companies do. They tend to hire as soon as they know that things are actually recovering. So this is the unemployment rate mapped over the same thing I showed you before with the green recession lines. Unemployment tends to peak at the end or after a recession is even over. So people thinking that, well, we need unemployment to drop down to normal levels to get out of this recession, in reality, more than likely, it's going to continue where it is currently for a time being. It may even go up higher. With GDP where it currently is, unfortunately, we can't bring the unemployment rate down. We need GDP to increase because of population growth to actually bring unemployment back down. And we don't actually see that happening until next year, where potentially unemployment could start falling, and unfortunately it falls at a rate twice as slow as it went up. So this would mean that unemployment could fall at about a rate of 1% per year, meaning that we have about a 5-year window to get back to full employment. What tends to happen when people hear that things are getting better is they tend to start going to look for work. The people that haven't been looking for work because there's no jobs out there tend to re-enter the market. And what that'll do is actually push up the unemployment rate because they're currently not counted in that. So unfortunately, what we'll see probably towards the end of the year is this 9.6 unemployment rate actually start to creep up even higher as people start to look for more jobs that are out there. One of the questions we get almost on a daily basis is, what are the analysts predicting? As we heard earlier, it's very difficult to predict where things will be in 6 months from today. What the Wall Street Journal did is they actually polled economists over the last several years, just asked them, where will interest rates be 6 months from today, higher or lower? And this charts back from, I believe, 1992, where they just projected if economists were right or if they were wrong. And all they had to do was answer if rates will be higher or lower. And what tended to happen is they're actually more wrong more often than they were right. I think it's going to actually be easier to predict pretty soon because the 10-year Treasury is pretty low right now. 5 years selling at just above 1%. So ultimately there's a floor that they have to benefit them. It can't go much lower. There are also, Barron's actually did this poll where they're asked to forecast what the market will do each year. The actual change and the forecasted change, you would call that a non-correlated line. So unfortunately, these market strategists are not very good at predicting where the markets will actually be for the following year. And lastly, the analysts. They took a look at projected earnings versus the actual earnings. What they found is analysts weren't very good at predicting what earnings were, but earnings actually predicted what analysts would predict. So that was a good indicator of what they would predict. However, the line is after the forecasted line. So unfortunately, forecasts from analysts don't really amount to much. So unfortunately, a lot of investors are basing their investment decisions on some of these shows that we heard earlier where they're ringing the bell or they're blowing the horn to buy Microsoft or sell Google, and individuals and investors are trying to base their decisions on that. And in reality, what those shows are is they're just shows trying to sell advertising. So what they'll do is they'll get somebody on there that will say the Dow's going to go to 20,000, and they'll get somebody on there that the Dow's going to 0, and they'll have them yell at each other for a little while, and then they'll cut to commercial because it makes for good television. What doesn't make for good television is what we heard earlier with a buy and hold philosophy where you stick with the strategy over a long term. That's not going to sell a lot of commercial time. So unfortunately, that's where a lot of investors tend to focus.